My name is Wang Jinheng with method number 299277. Today I want to present my individual report. The determinants of Abu Dhabi Commercial Bank credit risk. The determinants use internal and external factors to determine the Abu Dhabi Commercial Bank credit risk. The breakout of UAE. It is formed in 1971. It made up of seven emirates: Abu Dhabi, Dubai, Sharjah, Asman, Al Quwait, Ras Al Khaimah, and Fujairah. It's known for oil well, modern development, and Islamic tradition. Abu Dhabi is the capital and political center, and Dubai is the global hub for commerce, banking, and tourism. Economy driven by oil trade and tourism, Federal Supreme Council governs as a monarchy, ensuring stability and growth. It is popular for its unique lifestyle and attracting millions of visitors yearly. The problem statement: banks are closely linked to credit risk. High credit risk can severely impact the economy. Poor performance by one bank may affect the entire financial system, and also known as the domino effect. An unstable financial sector endangers national economic stability. For example, Great Depression in the US in 1930 showed the effects of banking failure. The study objective is to analyze factors influencing credit risk in Abu Dhabi Commercial Bank during 2040 until 2023. It has three research objectives. Number one is to determine the internal factors influencing the Abu Dhabi Commercial Bank's credit risk. The second one is to determine the external factors influencing the Abu Dhabi Commercial Bank credit risk. And the last one is to determine the internal and external factors influencing the Abu Dhabi Commercial Bank credit risk. Come to the literature review. It have three parts. The first one is credit risk. It is computed by dividing the total number of non-performing loans by the total number of bank loans made during a given year. Based on historical data, Rajan claimed that inadequate credit risk management is the primary cause of the most bank failures. The second one is loan loss provision. A loan loss provision is sum of money that banks set aside to cover loans that are unlikely to be repaid. Keelik found that the implementation of accounting rules such as SFAS 133 has affected how banks utilize loan loss provision for income smoothing. And the last one is market risk. A risk that might have an immediate impact on the whole market is another term for market risk. Resta and McNamara found that unfavorable raw material price change shift in the general level of pricing, like inflation, shifting consumer preference, new technology, and increased competition from rivals are some examples of market hazard. The methodology is to investigate the connection between Abu Dhabi Commercial Bank's credit risk and its determinants. The data were chosen from the bank's annual report from 2014 to 2023. The chosen data will be calculated to financial ratios like ROA, ROE, loan loss provision, leverage, and other ratios. The ratio will be analyzed through linear regression by using SPSS to generate discrete statistic, correlation, model summary, and coefficient table. The credit risk is the dependent variable, and internal factors, external factors, and internal and external factors is the independent variable for this study. For the descriptive statistics, the mean and the standard deviation of the credit risk is 0.039 and 0.0129. This indicates that the business effectively managed its credit risk and risk level of the company maintains stable. Based on the generated data in 10-year period, ADCB has a healthy credit environment with manageable and predictable risk level. For the correlation, loan loss provision show a significant positive and strong correlated with dependent variable credit risk with the p-value of 0.029, and the leverage show the significant negative and strong correlated with the dependent variable credit risk with the p-value of 0.024. However, because of the p-value is greater than 0.1 and negatively significant correlation, the credit risk is not significantly impacted by ROE, debt to equity ratio, risk-weighted asset ratio, GDP growth, inflation, and exchange rate. For the model summary, Model 1 internal variables show that 6 of the 11 factors had an impact on ADCB credit risk by the R-square of 0.988 or 99%. For the Model 2 external variables, the credit risk of ADCB was influenced by each of the 4 variables with 17 R-square of 0.165. And for the Model 3 internal and external variables, 8 of the 16 variables had an impact on ADCB's credit risk by an adjusted R-square of 0.995 or 99%. For the coefficient, Model 1 internal variables show that ROA, loan loss position, and risk-weighted asset are significant to the dependent variable credit risk because of its p-value lower than 0.1 with 0.015, 0.016, and 0.053. For the Model 2 external variables, inflation, GDP growth, interest rate, and exchange rate do not significantly affect credit risk since their p-values are larger than 0.1. For the monetary internal and external variables, only loan loss provision is significantly correlated with the dependent variables credit risk because of the p-value of 0.062. For conclusion, the credit risk of Abu Dhabi Commercial Bank is thus more significantly impacted by internal and external factors than by internal variable model 1 and continue with external variable model 2, according to a considerable body of research. The recommendation for ADCB is to improve credit evaluation using advanced statistical methods. Second is to ensure staff receive proper training on emerging credit risk, diversify loan portfolio across industry to reduce concentration risk, use strong monitoring system to track borrower financial health, adopt fintech tools for real-time exposure analysis, and the last one is focus on risk control to protect profits and support sustainable growth.